Hello friends, welcome to today's session. I am your Renu ma'am and today we will learn some of the basic accounting terms. This topic has been divided into two sessions. In today's session we will learn few of them using a simple example and we'll continue in the second part with the rest of the basic accounting terms. So now let's look at the example. We will take this example of Miss Smita. Miss Smita started business of sale of ready-made garments for children with a capital of say rupees 10 lakh. She spent around 1 lakh rupees on furnishing the interiors of her showroom. She spent rupees 50,000 on purchase of a computer. She purchased from Ravi Garments worth rupees 1 lakh for and rupees for cash 1,25,000. She sold garments costing 1,50,000 for rupees 2 lakh for cash and rupees 50,000 worth goods to Sheetal for 60,000. Goods worth rupees 10,000, the cost of which was 7,000, were returned by customers. These were returned back to the supplier for being defective. As business progressed, she decided to deal in ladies' ready-made garments and she made further purchases from Ramesh for rupees 1,50,000. She sold goods costing 1 lakh for rupees 1,30,000 at a discount of rupees 3,000. The customer was further allowed a discount of rupees 2,000 for paying the dues early. She has paid to her employee salary of 44,000 and rupees 4,000 was still payable. She paid rent of 65,000, out of which rupees 5,000 was related to rent of the next year. She withdrew rupees 25,000 for personal use and took home some ready-made garments for her personal use worth rupees 3,000. Using this particular live example, let us understand the different basic accounting terms. The first term that we will take up is the term proprietor. Here, whom do you refer as proprietor? It is a person who makes investments. So here we are referring to a person who makes investments in a business. He is going to be carrying on the business and all the liabilities of the business would be upon him. It will be the risk associated with the business would also be borne by this person. In our example, here Miss Mitha is the proprietor of the business. She has started the business. She has brought in amount of rupees 10 lakh into the business. So she has invested. She is going to carry on the business and the risk associated with business also she is going to bear. So she is the proprietor of the business. That is, in this case it is Miss Smitha who has invested rupees 10 lakh. Going to the next accounting term, that is capital. Now, what do you mean by capital? The amount which is invested in the business. In this case, Smita has brought in an amount of rupees 10 lakh into the business. This is her capital. This is also the liability of the business towards the proprietor, towards the owner or the proprietor of the business. So business owes Smita 10 lakh because she contributed 10 lakh. She invested in the business 10 lakh. This 10 lakh we call as capital and we would put it into account called as capital account. It is liability of the business, but it is an internal liability. It is a liability owed towards the owner, that is Miss Mitha. So that is the meaning of the term capital. The next term is assets. Now, let us look at the example. Having brought in the capital of 10 lakh, she spent out of that 1 lakh on furnishing the interiors, which means she has rented out a showroom. She has done interiors of that. So, furniture and fitting is the account where we'll be debiting this 1 lakh. It is an asset. It is not going to be used up in 1 year, but is going to be used in the business as long as she is going to carry on the business. So it is an asset. Similarly, she has also spent 50,000 on purchase of a computer. Now she has a showroom, she has to do the billing and maintain records, so she has purchased a computer. So this two money spent of rupees 1 lakh, that is on furniture and fitting, that is for the furnishing, and rupees 50,000 that she has spent on computers. This two expenditure that she has incurred is an asset. It is in the nature of capital expenditure. As we move further, we'll be learning in detail about the different types of expenditures. In that, you will understand what is meant by capital expenditure. Basically, what do you mean by asset? From this example, what do we understand? It is nothing but the properties owned by business. Now the business owns furniture and fittings worth 1 lakh and computers worth 1 lakh. It is the resource of the business. It is the resource of the business. Using this, business is going to be carried on. And it is that type of expenditure where the benefit from which is going to be received over not just one accounting year, but it is going to extend to many years to come. Having furnished her showroom, having purchased a computer, she is not going to be using it for only 1 year. It is going to be used as long as it is capable, it is in working condition, it can be used, it's going to be used, and the benefit of it is going to be available to the business for many years to come. And therefore, those type of things are called as assets. Now further, there are several classifications of asset, like you have the tangible assets. Tangible assets means those assets which you can see, which has physical existence. What do you mean by physical existence? Means which can be seen, which can be touched and felt. You can see it, you can touch it. Like in this case, you have the furniture fitting which you can see physically present there. You can touch it. There's a computer which is physically present there. It can be seen, it can be touched. They are tangible assets. And the other type of asset is intangible assets. Intangible assets are those assets which do not have physical existence. So, which means you cannot see it or touch it, but still it is there and it is an asset. A very good example now, she has purchased computer. She needs to purchase computer software. Can we see the software? Can we physically touch the software? No, but still it is required for the computer to be utilized. So computer software is an intangible asset which he would be purchasing maybe along with the computer. So this is the general classification of assets into tangible and intangible asset. Now further, there is classification of assets. You can further classify them into current assets, non-current assets, and fictitious assets. Now, what do you mean by current assets? Assets which are held by the entity for being converted into cash within a short period of time. Like the goods that is being purchased by Smita is an asset. It is going to be put into an account called as stock account. That is going to get converted into cash when there is a sale of that. Smita sells those goods and gets it converted to cash. So we would classify the goods as a current asset. Whereas non-current assets are those assets which are held by the entity not for purpose of resale. Held not for resale. Like our computers. That is not purchased with the intention of selling it at a profit. It is going to be kept in the business, used as a resource of the business. In running the business, it is going to be used. It is not for purpose of resale, but for use in business operation. It is going to be used in business operations. So that type of assets is non-current asset. So under the non-current asset, you have several classifications like the tangible and intangible assets. And last type of asset is the fictitious assets. Fictitious assets are actually not real assets. They are those which are neither tangible nor intangible assets. So you can say they are neither tangible assets nor intangible assets. So what do we mean by this? They are not tangible assets, means you cannot see and feel it. It's not intangible assets, which cannot be seen or not felt, but still it is there. That is intangible asset. But we're saying fictitious asset is a category where it is not a tangible asset. You cannot classify it as intangible asset. What type of that asset we are talking about here? Now, normally, like a very good example for this would be when you see a new product is being launched, you will see lot of advertisement back to back on television. When you're watching any particular movie or a serial, you will find there is back to back advertising. So huge amount of cost is being incurred by the business when they go for such advertising of launch of a product. Now that cost which is being incurred, that would boost up their sales. So it is going to benefit the business. So in that way, it is an asset for the business. But still, advertisement cost is an expenditure. Normally, advertisement expenditure, we take it as a revenue expenditure. We would be writing it off in the same year. But this type of huge advertisement cost which is being incurred, it is going to give benefit not for just one accounting period, but it is going to give benefit over several accounting periods. You advertise your new product now heavily. You are going to create a customer base which might be there for next 3 to 5 years. So logically it would be correct that as a prudent person, you should write off this advertisement expenditure also over the next 3 to 5 years. So suppose they have incurred 5 crores as advertisement expenditure, and it is expected that the benefit would be available for next 5 years. You are going to ensure that the sales would be high because of this huge advertising the next 5 years. Then every year 1 crore would be written off, and the rest of the amount, the balance, would be kept in the asset as a fictitious asset. This is not an asset which is going to be used physically, but it is giving benefit over a number of years. So this type of expenditure is treated as an asset and shown in the balance sheet for the next 5 years. At the end of the 5 years, it will be out of the balance sheet, and every year a proportionate amount would be charged to the revenue. So that type of asset is a fictitious asset. So this is in detail about assets. In this example, if you see, you can find current assets in the form of your stock. that has been purchased. All the goods purchased is not sold. When it's purchased, it's put into stock, then sold. At the end of the year, some of the goods might be remaining. That would be shown in the balance sheet as stock. That would be shown under the head current asset. And under non-current asset, you have here the furniture and fittings and your computer. These are non-current asset under that tangible assets. And you would also have the software that you purchase, the computer software, under the intangible asset under the non-current asset category. In this example, we have not taken an example of fictitious asset. So I hope with this, the term assets is clear. Now moving further, let us go into the example. What she did after purchasing the assets. She went in and purchased from Ravi ready-made garments. She has started with buying and selling of garments for children. So she went to Ravi, who is maybe a wholesaler or a manufacturer of garments for children, ready-made garments for children. She went to Ravi and bought garments worth rupees 1 lakh. And for cash, one more purchase she made. For cash, she paid here cash immediately and purchased 1,25,000. So now from this we will understand the term purchase. Now she has made purchase. So what do we mean by purchase? Purchase is nothing but buying of goods for resale. In this example, it is for resale, or it can be even for manufacturing. If it is a manufacturing concern, not a retail outlet like in the case of example we have taken. If it is a manufacturing concern, any material which is purchased to be introduced into a manufacturing process, that purchase buying of those goods would be put into the purchase account. Now we'll take the example of our current example of Smitha. She has purchased from Ravi goods worth 1 lakh, and she has also purchased again but by paying cash rupees around 1,25,000. So these two together form the purchase of the business. But from this we understand further that you can make two types of purchase. So two types of purchase. What are the two types of purchase? One, it is cash purchase. That is where Smitha has paid cash 1,25,000 and purchased the goods. Immediately payment was made. The second one is the credit purchase. That is, when she purchased from Ravi, you find from the wordings that she has purchased from Ravi goods worth 1 lakh. There you don't find any detail about how she paid, whether by cash or by check, nothing. So we understand that she has not paid anything immediately. So that amounts to credit purchase. Credit purchase is when purchase is made, goods are received from Ravi into the showroom by Smitha, but she is going to make the payment at a later date. So here in case of cash purchase, there is an immediate payment made. But in case of credit purchase, the payment is made at a later date. So payment at a later date. So maybe probably after a month or two. Credit period might be provided by Ravi saying that okay, you pay after a month. So that is a credit purchase, and 1 month is a credit period which has been given to her. So this is the meaning of the term purchase. When it is purchased for reselling or for manufacturing purpose, then that type of transaction we call as purchase. And there are two types of purchase, cash and credit purchase. Now further, next term that I will be discussing with you is the term creditor. Now just now we saw that Smita purchased from Ravi goods worth 1 lakh rupees. So she is paying for those goods at a later date. So here Ravi is the creditor. Ravi is the creditor. He has given goods on credit. He has to be paid the amount at a later date. So creditor is basically as a result of credit transaction. Because of credit purchase, a creditor is created and a liability is created because of this credit purchase. A liability is created and amount is owed by the business to the creditor, which means Smita owes, she has to pay Ravi 1 lakh rupees at a later date. So it is a liability of the business and Ravi is a creditor of the business. Therefore, we know who is a creditor? Ravi. And what is the amount of liability? In this case, it is 1 lakh rupees because purchase of 1 lakh was made during the year. So, from Ravi. So, this is the meaning of the term credit. Now, moving further into the example, let us look. She sold garments costing 1,50,000 for rupees 2 lakh for cash. So, she has sold garments. Let us note this down. We will learn about sales now. Now, there was a sale of garments costing rupees 1,50,000 for 2 lakh for cash. So, costing 1,50,000 rupees sold for 2 lakhs and that was for cash. And goods rupees 50,000 worth of goods to Sheetal for 60,000. So she has sold here to other person goods costing 50,000 rupees. It has been sold to Sheetal for rupees 60,000 rupees. Now, using this transaction, we can understand that sale is nothing but selling of goods which has been purchased, or if it is a manufacturing concern, which has been manufactured by the business. Now, in this case, Smita sold goods for cash. The goods were worth 1,50,000. She added profit margin and she was able to sell it for 2 lakh. And she again made one more sale for rupees 60,000, the cost of which was 50,000. So she had purchased it for 50,000 and she sold it for 60,000. So totally through this transaction, she has made a sale of rupees 2,60,000. So this is sale. Whatever goods she purchased, she has sold, and 2 lakh worth of goods which is purchased has been sold for 2,60,000. Now further from this transaction, you also understand that there are two types of sales. Namely, cash sales, where immediately cash is being received. So cash is received here immediately. The goods is sold and immediately money is received. The other type of sale is called as credit sales, where cash is received at a later date. Like in this case, goods were sold to Sheetal for 60,000, but the 60,000 is not being received immediately. It is being received at a later date, probably Smita has told Sheetal, okay, you pay after 15 days or after 1 month or after 2 months. Whatever is the credit period she has offered, on that basis, after that credit period, she would be paying the amount to Smita. So, from this transaction, we understand the meaning of the term sales and that there are two types of sales, cash sales and credit sales. Now moving further, we will go to the next accounting term called as debtors. Now, just now we saw the meaning of the term sales and we found out there were two types of sales, cash sale, credit sale. Now, when there's a credit sale, we also learned that in case of credit sale, the payment is going to be received at a later date. And therefore, when there is a credit transaction, so when there is a credit sale, it results in debtors. So you can say debtors is a result of credit sale. So when there is a credit sale, you will find debtors in the book. So debtors are those persons who owe money amount to the business. So in this example, if you take Sheetal, to whom goods have been sold worth, she has to pay 60,000. So Sheetal is a debtor. So Sheetal is debtor of Smita. Smita is the creditor for Sheetal because Sheetal has to pay Smita, whereas Sheetal is a debtor of Smita. So this is debtor. Now where do we classify debtors? Debtors, you can see that the payment is going to be received in the near future, in a very short period of time, maybe a month or two. And therefore, it is going to be classified under the current assets. Whereas in the case of creditors, we would classify it under current liabilities, which we'll be learning in detail probably in the next session when we go into the details of current liabilities. I hope with this debtors term is clear. Now moving further into the example, if we see here, goods worth rupees 10,000 were returned by the customer, the cost of which was 7,000. So what has happened here is, we will be learning the term purchase return and sales return. What has happened is, there were goods which were sold for rupees 10,000 has been returned, the cost of which is 7,000 rupees. So the customer who took the goods pay the amount of, might be from Sheetal, 10,000 worth goods have come back into the business, and those goods, cost of which were 7,000. So first we will take the term sales return. Now goods were returned by the customer, the goods which have been sold. So goods sold, returned by the customers is put into sales return. Why would customers return goods? It might be because there might be some defects in it. So maybe the goods are defective, or it might not be as per the sample. Probably they have taken in huge lot and some sample of that material was shown, but when taken to their place of business, they opened and saw it, they found that it was not the same type as they wanted. So probably they are returning it back. So there could be several reasons, or the size is not fitting. So there are several reasons because of which goods might be returned. That goods which are returned by the customers is put into the sales return. Here Where will we put this sales return? It is normally you would deduct it from sales. Your sales would go down to the extent of the sales return. And another term which is used for sales return is return inward. If you find this word return inward, it is nothing but sales return. Return inward, return which is coming back into the business. When can goods come back into the business? When it has been sold, it goes to the customer, and then from the customer it is returned back, then it is coming back into the business. So return inward is another term which is used for sales return. In this case, the sales return is worth rupees 10,000, which would be deducted from the sales. The next term is purchase return. Now they have given, going back into example, if you see, goods worth rupees 10,000, cost of which was 7,000 were returned by customers. So that was sales return. These were returned back to the supplier for being defective. So these have been returned back to the suppliers. So what are we doing? We are returning back whatever defective goods which were received. Smita got it from her customer back saying that it's defective. So that was her sales return. That she is going to return back to her supplier or seller. So the goods which are returned to the suppliers or the sellers. So goods which were purchased and now they are returned back to the seller, probably again because they are defective or they are not as per sample, whatever the case, then they are called as purchase return. What do we do with this? We put it into the purchase return account and then we deduct it from the purchase amount. From the total purchase, we would subtract this purchase return. And there's one more term that can be used for purchase return, and that is return outward. From the term outward, you can understand goods have come into the business when it were returned back by the customer. So that was return inward. Now having come into the business, now Smita is going to return it back to her supplier. So the goods are going to go out of the business. So that is outward. So that's a return which is going outside. So another term used for purchase return is return outward. And the value of purchase return in this example would be the cost. So the purchase return would be for 7,000 rupees. 10,000 was the value at which it was sold to the customer and they returned it. So we would put the sales return as 10,000, the cost of which was 7,000. So when Smita is returning back those goods to her supplier, she would have to credit purchase return with 7,000 rupees. So that is the meaning of the term purchase return. Finally, we would also learn one more term, that is goods. What do we mean by goods? Goods are nothing but those physical items which are purchased by the business for the purpose of sale. Now, in the given example, Smita was dealing with ready-made garments for children. So, the purchase that she makes and she sells it, those items that she is purchasing, those are called as goods for her business. So these are goods for Smita, for her business. Now let us take other examples, like if it is a retailer retailer is a person who sells goods to the ultimate customer. If he is purchasing and selling electronic items like TV, fridge, etc., then these are goods for the particular retailer. If it was a stationery shop, then the stationery items are goods for the stationer, the person who is carrying on the business of a stationery shop. Those stationery items like books, pen, pencils, stapler, puncture, and whatever is the item, files, whatever is being sold by him there, those items are the goods that are dealt with by him in the business. So from the today's session, we learned 10 accounting terms. One about proprietor, that is Smitha. Then we learned about the term capital, means the amount which she invested in the business. Then we learned about assets, that is the furniture fitting and the computer that she purchased for the purpose of business, which she is not going to resell, but she is going to use it in the business. Then we learned about the term purchase, that is the goods that she deals with, items, physical items that she deals with in the business, which she purchased for the purpose of resale. And we also learned that there are two types of purchase, cash purchase and credit purchase. Now with the credit purchase, we learned about the term creditor. In this case, Mr. Ravi is a creditor for Smitha, to whom Smitha owes money. She has to pay at a later date, who will be classified under current liability in the balance sheet. Then we learned about the term sales, where she sold goods to her customers, and we also learned there could be two types of sales, cash sales and credit sales. That is the sales where immediately cash was received and credit sale where money is going to be received at a later date after the credit period. And we learned that when there is a credit sale, there is a debtor. Sheetal was a debtor for Smitha. Sheetal owes 60,000 to Smitha. She will pay at a later date. And then we learned about the terms sales return. When the goods sold were returned back by the customer to Smitha, it was sales return, also called as return inward, which would be subtracted from the sales. And these were going to be returned back to the supplier by Smitha. Whoever sold her those goods, she's going to return back to them. And at that time, you will take the cost at which it was purchased, at that value it is going to be returned. So that was called as purchase return. Whatever is being purchased is being returned for being defective and being put into account called as purchase return, which would be subtracted from purchase. Another term that is used for purchase return was return outward. And finally, we also understood the term goods. That is, these ready-made garments which is being purchased for being resold at a profit, those physical items that she is dealing with in the business is termed as goods in a business. So today we have learned around 10 basic accounting terms. We will learn as we progress further in the next session, in the part 2 of this session. I'll be discussing with you by reading through this example. We'll be learning several other accounting terms. So please stay tuned, and if you like today's session, please do like, share and subscribe to it. Thank you. Have a great day.